Hey everyone, if your company has recently acquired another business or you are planning to, this is one of the most common and costly mistakes I see during acquisition accounting, not performing fair value adjustments. Most companies just take their net assets from their balance sheet as they are and plug into their consolidation. But that's not what accounting standards actually requires. Let's talk about why fair value adjustments are very important and what happens when you skip them. When you buy a company, you're not buying their old balance sheet, but you're actually buying their current value. Now let me give you an example. If a company A acquires company B at a worth of 10 million, the company B's balance sheet says their net asset worth 7 million. Most of the people stop there and says, alright, 10 million is my purchase consideration and 7 million is the net asset. So the difference 3 million would be my goodwill. But here's the problem. Those 7 million of net assets are based on historical cost and not the fair value. For example, they have a building which carried at a cost of 500k, but it actually worth 800k now. Machinery, which they bought 10 years ago, having a net book value of 1 million, but having a worth of 600k now. Inventory that could include an obsolete stocks, which may require a provisioning, and some liabilities like warranties or other provisions that may be understated. Now, if you ignore those adjustments, your balance sheet would be wrong from day one. This means that your goodwill is also wrong. And over the time, your depreciation, impairment, your profits, all may be misleading. The fair value adjustments give you a clean, accurate, and a starting point. They make sure that all assets and liabilities that you have acquired are recorded at a true market value at a date of acquisition, so you can see what actually you have paid for. It's the only way to measure the real return on your investments, the correct value of your goodwill, and whether your acquisition is genuinely profitable. So why do many SMEs skip this step? Usually it's because they think it's too complicated, time consuming, and it's not required for smaller groups. But in reality, the fair value measurement is very important in a business combination. And it doesn't have to be complicated. You just need a structured purchase price allocation process. Identify all your assets and liabilities acquired, revalue them to a fair value, and recognize goodwill for a difference. This one step brings your consolidated accounts in line with the accounting standards and gives you credibility with investors, banks, and auditors. So, in summary, skipping fair value adjustment seems like a shortcut. It's like building your house on a cracked foundation. Fair value ensures your group accounts are solid, transparent, and ready for future growth or investments. So if you have recently made an acquisition and wants to make sure that your accounts reflects the true value of what you have bought, drop me a message and I will share you a guide on how to perform a fair value review without overcomplicating it. Thanks for watching.